gross domestic product, monetary policy, fiscal policy, liquidity ratio, inflation rate, balance of payments. What does this all mean? Welcome to the second episode of Finance Unplugged. In this episode, we're discussing the complex world of financial markets. Now, in this episode, we're going to discuss the key trends and events that shaped the first quarter of 2021 and discuss the future, or probably even predict the future events that could happen in the year 2024. Did you know that the South African economy in the first quarter grew by 0.6%? Or that the financial sector remained resilient despite the global challenges? Or that unemployment remains at an all-time high at 32.6%, posing significant socioeconomic challenges? And with inflation rates fluctuating and the Reserve Bank adjusting interest rates to maintain stability, it's very crucial and important to know how that affects your everyday life and investments. To help us make sense of the complex terms and figures, I brought an expert who's going to provide insights and clarification on the second quarter of 2024. So stay tuned as we delve into an in-depth analysis of the second quarter of 2024.
Sure. So my name is Mohammed Nalla, and I am a financial markets analyst. Effectively, I'm one half of the duo that brings you Magic Markets, which is a very popular top 10 rated investments podcast in South Africa. And I'm just keen to try and unpack some of the news flow that you want to discuss now. Obviously, we've just gone through the second quarter, but let me first introduce myself. As I indicate, I'm Mohammed Nalla. And what is Magic Markets? Well, Magic Markets is actually a weekly podcast and a report where we cover global economic and markets news on a regular basis, bringing you the most topical stories that you're going to find globally. And it features a weekly deep dive report into global companies. We look at their financial performance from the bottom up. We then also include an analysis of the competitors, of management. We feature a bull and a bear box and an overall investment thesis. So if you want to think of this, think of it as a weekly case study into global companies. And there's an extensive library of over 130 companies that we've actually covered so far. Now, subscribers can get this all for just 99 Rand per month. But here's the rub. As a WITS Investment Society member, you will get an additional 20% discount off both our annual or our monthly subscriptions. And again, as I indicated, the monthly subscription, that's normally 99 Rand a month. You'll get that for 79 Rand a month. Our annual subscription actually gives you a further 2 months free. So it actually works out to 990 Rands per year. But as a WITS Investment Society member, you can get that for 790. So you can choose that. It's a 20% discount across the board for WITS Investment Society members. And think of this as the best investment that you can make into your real world knowledge of how financial markets and companies operate globally. You can also follow us on X. It's at Magic Markets Pod, one word. My handle is at Mohammed Nalla. And you can go and sign up now at www.magic-markets.com and use the code word WITSMAGIC. That's one word, WITSMAGIC, to claim your discounted subscription. Really excited about the discussion we're going to have today, Thabang.
Just to ask about Magic Markets, usually when we're looking for high-level information, it's quite costly. So I think Magic Markets, is of value, gives you value for money because you're getting exclusive, relevant, latest news on financial markets. So make sure, guys, to subscribe and to get the package. Finance Unplugged caters to a whole range of people from finance, people from engineering. So I think we could start off by just probably discussing or defining what exactly is or what is financial markets.
So I think that's a great place to start because, we tend to speak about financial markets or the markets as almost this very obscure, it's an amorphous entity out there. And quite simplistically, if you look at financial markets, a lot of people either just speak about the equity market, or a lot of people just speak about the currency, or some people just look at gold. If you think of your news in the evening, they show you what's happened on equity markets, what's happened with the Rand, what's happening with commodity prices. But financial markets actually cuts across all of that. You've got to include what's happening with South African bonds, for example. And remember, you can break this down into just South Africa or you can also look at this on a global basis. So when you look at financial markets, effectively it's where people buy securities that give them access to the financial performance, whether that's of companies or whether that's through bonds, buying the financial performance or returns from countries. If you want to get exposure to specific commodities, whether that's oil or gold, or in South Africa, you might want corn or wheat futures, for example. All of these commodities, these assets have to trade somewhere, and they trade on financial markets. As I indicated, usually listed markets when we're talking financial markets in general. It's not exclusive to that. There is a large unlisted market as well, but that's probably beyond the scope of the kind of general use of the term financial markets. And like I say, today in our discussion, we're going to unpack, what is financial markets? What have they done across the board? Looking at South Africa, looking at global, looking at all of those various asset classes. So quite a wide-ranging discussion, which I think sets a nice foundation for us to try and educate the members of your society.
How do we measure progress? How do we put a number to it? How do we see that we're moving in the right direction? Currently in South Africa, we have this GNU sort of concept where we're having this integrated mix of different political parties who are going to actually have a say on the direction of, this African economy. We have the rand against the dollar, which weakens and strengthens. We have so many incidents that happen that affect our economy. So how do we exactly measure the progress? How do we measure that we're going actually in the right direction? And are there indicators that one can make reference to see that we're actually moving in the right direction?
So first and foremost, if you're talking exclusively financial markets, I guess the best measure of progress are just returns. What returns do you actually generate from deploying capital? And there, simplistically, you could either just look at share price returns, or what's the return on the headline indices or indexes. And there, for example, in South Africa, you've got the JSE All Share, or you've got the JSE Top 40, which are the top 40 largest companies listed in South Africa. And so if you want to map progress purely on the financial market side, you would look at what are the share price returns over time. You'd also want to look at what are the dividend returns coming through to you. So a lot of people just tend to look at price, but if you are a long-term investor, you want to look at total return, because total return actually includes the share price movement as well as the dividends that you would earn by being invested in various companies or stocks and so forth. When you're looking at bond markets, for example, bonds usually try and pay you an interest rate effectively. And so you'd look at the bond coupon, that's the interest return, but you also want to look at what's happening with bond prices. So, simplistically, that's how you would measure progress. Now, you've raised a very important point. In South Africa at the moment, everyone's talking about the GNU. I call it the new, because we actually just released the Magic Markets podcast this week, and we've called it the new dawn. That's the GNU dawn. And we discussed some of these issues on there. You want to go and check that out again on the website, www.magic-markets.com. But trying to tie in the macroeconomic performance, the political news flow, you tend to see that expressed very directly in a currency. So a lot of people say that a currency is almost like the share price of a country. What does the market think about what's happening on the political spectrum at this point in time? And you see that expressed in the currency. You also see that expressed in South African government bond yields. And so that is how you'd see the tie-up between the macroeconomy, the political news flow. Generally, they get expressed through the currency, through the bond yields first, and then subsequently through the impact on equity prices as well.
Obviously, we're looking at it from a macroeconomic perspective, right? We have such factors like inflation, interest rates, government policy. How does that sort of shape financial markets, especially the performance since we're in the second quarter?
So let's first touch on inflation. Let's talk about monetary policy, because you've got to break down. So from a macroeconomic perspective, there's monetary policy, which is generally the South African Reserve Bank's purview. They operate in that space. They are responsible for monetary policy. And then you also have fiscal policy. And fiscal policy is effectively the government. And this is where government will either enact taxation or spending plans. And those have differentiated impacts in terms of the overall economic performance. So starting off with inflation, first and foremost, I must stress the South African Reserve Bank is probably one of the most well-respected reserve banks or central banks globally. We've had some consistency there in terms of leadership under Governor Lesetja Kganyago, and he's well respected, not just by the markets, but in general, also with regards to sticking to his mandate. Remember, the mandate of the Reserve Bank in South Africa is price stability, trying to keep inflation down. Now, we know what happened during the pandemic. We actually had inflation globally ratcheting up to levels we had not seen in a very long time, almost twice the targeted levels of global central banks by quite some margin. And with South Africa, we also saw that uptick in inflation, but then you saw a very responsible response from the South African Reserve Bank. They kept interest rates high because remember, higher interest rates curtail expenditure to a degree, and that helps contain inflation. I'm not going to go into the full economic relationship in terms of how that works. Just take it from me. If you have higher interest rates, it curtails spend, that then curtails inflation. Now, why this focus on inflation is because research has shown that inflation actually hurts the poorest of the poor the most, especially in South Africa. If you have a look at how people that are less well off spend their money, it's disproportionately on food and fuel or transport, if you want to look at that. And so if you have inflation running particularly hot, it tends to impact the spending of the poorest people the most. It erodes their disposable income. So that's with regards to monetary policy. Like I say, South Africa, well respected. The interest rates have been kept quite stable. In fact, lots of talk now that they will be considering rate cuts. And I think we'll probably see some sort of, I wouldn't say coordination, but some correlation between a decrease in interest rates globally and then in South Africa. Now, how does that filter through to the rest of the economy? If interest rates are cut, obviously inflation is now within the targeted 3 to 6% range in South Africa. It's not quite where the Reserve Bank wants it to be. So don't expect significant cuts, but expect some sort of relief. As interest rates are brought down, that then decreases the cost of capital for companies. It incentivizes companies to maybe start investing. It makes some of the projects that they were considering a lot more viable. And so you start to see that uptick come through theoretically in growth. And as that happens, you start to see the impact come through towards, the general economic performance. And then when you're looking at equity performance, a lower discount rate, lower interest rates effectively means that when you're bringing through those valuations to what is priced into a stock today, it actually has a positive impact theoretically, again, in terms of the long run return that you can see. So that's just trying to wrap up how interest rates play into the rest of the economy. One last point, fiscal policy. When you're looking at fiscal policy, government spend, South Africa has been running significant deficits. Now, what are deficits? It simply means they're spending a lot more money than they're actually getting in. Now, where does that money come from? They've got to actually go into international financial markets to raise that money. They've got to go out, the same as you and I, if you want to go and buy a house, for example, you take out a mortgage bond. And this is effectively South Africa going out there, placing bonds in the international financial markets that investors, pension funds, and the like will buy. And that's effectively them borrowing money in order to keep paying the bills, in order to fund those deficits. So the risk here is if they spend a lot more than they're actually getting in, and this is unsustainable over the longer term, that's going to start to come through in terms of higher bond yields, a higher cost of capital. So that's the interplay between interest rates that you're seeing from the Reserve Bank, but then also the fiscal running of the country. What bearing does that have on interest rates and also effectively corporate cost of capital over the long term?
So recently we've had a bit of political instability, or one can actually argue and say, yes, we've had a bit of political instability. We've noticed that politics does actually influence the financial markets, specifically currency. We've seen that when Zuma speaks, the rand weakens, and when Ramaphosa speaks, that the rand sort of strengthens again. So I mean, how important is political instability when looking at financial markets?
So it's quite important, in the short term, because markets tend to oscillate. They move from extremes. They're either extremely optimistic or extremely pessimistic. And we've seen this before. Back when Ramaphosa first assumed office, there was this whole thing called Ramaphoria. And I remember speaking to investors back then saying, you know what, you're going to get very excited about this. But over the longer term, you've got to look at some of those macroeconomic indicators we're talking about to really inform what is the trajectory that the country is on. And that's going to determine your long-term performance. So as I indicate, there's a short-term impact. There's a lot of noise that comes out of that. But the longer-term impact is directly determined by what are the policies you're putting in place? Are they business friendly? Can we actually secure electricity supply? Can we get our logistics infrastructure to start to work better? And we can unpack a lot of that in detail in this discussion. But a point I want to touch on, because you brought it up, you look at the currency and you see a lot of volatility. Well, in fact, if you look at the rand, and let's look at the first half of this year, because we've just gone through the second quarter. So let's look at the first half of this year. The rand has actually been remarkably stable over that time period. Yes, there's been a lot of uncertainty, and I say remarkably stable. What I mean when I say that is, yes, it's bounced around in pretty much like a 2 rand range against the US dollar. But in aggregate, if you have a look at it in terms of where we started the year and where we are now, it's pretty much flat. Now, this compares quite favorably when you look at other emerging markets out there that have come under a little bit of pressure. We're not alone when it comes to this political news flow. I mean, at the moment, as we speak, there's political uncertainty in the US. There's an election at the end of the year there. We've got political uncertainty. I think the UK is actually voting on the day we're recording this. You've had political uncertainty in France. So South Africa is not unique there, but from time to time, you get this political risk premium that tends to get priced into the rand, into the bonds, into equities. And so it does come through with a shorter term impact. Wrapping all of this up for the last quarter, in fact, if you have a look at it for year-to-date returns as well, South African equities have disappointed. They've been fairly muted. We've had 5.5% returns from equities. And if you look at bonds, which is the other asset class, traditionally less risky than equities, those have given you around 5.5% as well. So on a risk-adjusted basis, equities in South Africa haven't been a great place to play. And again, this is just at the headline level. Obviously, there are specific companies that have done very well and some that have done very badly. And then the other asset class you want to look at from an asset allocation perspective would be cash. Cash has given you around 4% for the first half of the year, which also on a risk-adjusted basis probably comes through more favorably than having been invested in equities. Now, if you look at South Africa and how we've performed versus the rest of the world, I indicated how the rand has been very stable. But if we look at our equity markets, for example, as I indicated, 5.5%, that's not something to get excited about. I'm going to do all of these returns in rand so that it's a like-for-like comparison, right? If you look at global equity markets, so something like the MSCI World Index, that's actually grown by 12% over the last 6 months. So more than double the return you got in South Africa. If we break that down further, where the return's coming from, emerging markets, because South Africa, let's look at our peer group, emerging markets outperformed South Africa. They gave you 7.5% versus 5.5%. And then a lot of the impetus in global equity markets, no surprise here, coming from the US. You know, you've got a big tech following in the US. You've got Nvidia coming through there. You've got the likes of Microsoft. They've all had phenomenal performances. And so if you wrap that up into what the US has done versus the rest of the world, the US markets have given you around 15% just for the first half of this year, which is an outsized return. Remember, when you look at equity markets over the longer term, usually you're kind of penciling in between 10 and 15% as a total annual return. So to get that in 6 months, on the back of a handful of tech stocks is a fairly risky position that we find ourselves in right now. And again, we'll see how the rest of this year plays out. Again, we can probably unpack some of that on the show.
So currently we do have a concept called balance of payments. And South Africa is currently running at a deficit where we're actually importing more than we're exporting, right? And that also sort of creates this negative ripple effect in terms of currency, financial markets. Could you further elaborate on our sort of balance of payments and how do we sort of maneuver around this deficit of balance of payments?
So again, an excellent question. So I want to almost break that down into several components, right? Is when you're looking at balance of payments, if you look at it on a GDP level, you're going to be looking at something called the current account surplus or deficit. And as you indicate, South Africa has run current account deficits for pretty much the last several years. And some of that is premised, if you break that down even further, some of that is premised on financial flows. So is foreign and local capital, is it coming into South Africa or is it leaving South Africa? And so that's very much on the financial side of the equation. But on the point I think you wanted to touch on here, and this is where I'm trying to elaborate a little bit further. A large component of that current account is the trade balance. So do we run a trade deficit or a trade surplus? And this is where it gets slightly more technical and I would say more interesting, not necessarily technical, but interesting, because South Africa traditionally tends to import a lot more than we export, yes, right? And if you look at that, if you look at the most recent data prints, because you actually get a trade balance number every month, if you look at that, we've actually had the last 2 months, we've had a surplus. So it is quite volatile. It depends on seasonality. It depends on, you know, who's buying what globally at a particular point in time. So it warrants us actually digesting that and unpacking it a little bit further, because we can't just say, hey, South Africa exports more, exports less than it imports. Let's unpack what that looks like. And so if we look at exports predominantly, South Africa has been known as being a very rich resources driven economy. And in fact, if you look at the composition for the year to date of exports specifically, around 26% of that are mineral products. So think of the stuff we dig out of the ground, ores. We actually export a lot of that. We export a lot of precious metals. We also export a lot of vehicles. Remember, we've got a large vehicle industry in South Africa, vehicle manufacturing industry. So that comes through quite strongly as well. But predominantly, I would still categorize South Africa as primarily a resources exporter. Now, if we look at the import side of the equation, we know that South Africa imports a lot of oil. And oil comes through around 20% of our imports. And this is because we don't have as much oil as we require. So we import a lot of that. But that's not where I want to focus, because there's also a large component of machinery and finished goods imports, right? So if you want to wrap this all up, South Africa takes unbeneficiated raw materials. We export that to the rest of the world. They produce something out of it, and then we import that. And that's where your structural imbalance comes from, is that South Africa is an economy that is known to have prematurely deindustrialized. What I mean when I say that is the traditional kind of, if you want to call it life cycle of an economy, is you start off agrarian, primary sectors, mining, agriculture, and so forth. As you migrate up that value chain, you're becoming manufacturing economy. So that's the secondary component of GDP. You manufacture a lot of stuff. Traditionally, you tend to export that for export markets, derive some earnings. And then as your economy matures, you then develop a very large services or tertiary segment of the economy. Now, in South Africa, if we look at it right now, we've got big primary and we've got very big tertiary, which is services. Think banking, financial services, all of that wraps up in there, right? And that middle is a piece where South Africa, I would argue is underrepresented. We've prematurely deindustrialized. Now, if South Africa wants to turn the corner in terms of the export-import imbalance, if we want to turn the corner in terms of the deficits you've indicated on the current account, on the trade account as well, over the longer term, speaking here, not just the last couple of months, South Africa has to seriously consider becoming a lot more active in the production space. And what I mean when I say that, the secondary part of the economy. Now, a couple of people might say, but China's so competitive. We can't compete with China. And they're probably right on that on a number of fronts. But South Africa is still a low-cost jurisdiction to produce goods and can still become a regional champion if we look at building out a manufacturing base. So wrapping all of that up, there's still lots of pockets of potential opportunity in South Africa as an economy that's prematurely deindustrialized. A lot of the, let's call it underperformance, probably comes through from that manufacturing segment. And if we really want to turn the corner, there are a couple of things we could do. We can do that in the primary sector. We can do it in the secondary sector. Our tertiary sector, pretty well developed and has been performing quite well. But in aggregate, if you want, we can actually try and unpack some of those. What do we do to get things right? Because there's a lot to unpack there. There's the energy story. There's logistics. We produce a lot of stuff. But again, I'll stop there and maybe pause for a breath.
In South Africa, we import a lot of raw materials, right? And as we said, that we need to develop our manufacturing sector where instead of exporting raw, we export finished products. So instead of exporting cocoa, we export chocolate. But speaking at it from a sort of a superficial sort of point of view, if South Africa did get to that level where we're actually, performing at the level that we are right now, how would that sort of look like for our financial markets or economy in South Africa?
There is a bit of a disconnect between, and perhaps this is a great place to speak about it, between financial markets in South Africa and the underlying economic performance. Now, what do I mean when I say that? Because I initially started out by saying these things are all linked. But if you look at the companies that are listed in South Africa, a lot of those companies derive a portion of their earnings in South Africa, but specifically the larger companies actually derive a large portion of their earnings from outside of South Africa. So sometimes you see that disconnect between listed equities and the underlying performance of the South African economy. But now to answer your question directly, if we start to get some of this right, some of it's going to probably come from investment by those big listed companies. Some of it's probably going to come from investment by unlisted companies. And South Africa's need at this point in time largely hinges around capital investment. We probably don't, yes, sure, we'll take the financial investment, and that's people coming into your equity market, coming into your bonds. But remember, financial flows are what I would call hot flows. They come in easily and they leave easily. We have deep liquid capital markets, which is a good thing, but it also means that you get some of that volatility. If you're talking about people sinking shovels into the ground, building factories, some real physical investment. That's what's going to start to move the needle in South Africa. Now, for too long, we've relied on government to actually fund a lot of the let's call it the real hard investment in the country. And I believe that we should actually look at how can we attract international capital into direct investment in South Africa. And that is a very big, very, very big question, because when I speak to international investors up here in North America, South Africa doesn't feature very highly on their agenda, because they're looking at other emerging markets where growth rates, GDP growth rates in other emerging markets are running at 5, 6, 7%. South Africa is running at sub 1%. If we do well, we'll get just above 1%. And so when you look at that, it's almost like a chicken and egg scenario, because you have to generate the growth to pop onto people's agendas. But if you don't generate the growth, you're not going to pop on the agendas and they're not going to invest. So how you get that catalyst is that you need to get all of the other building blocks right. And first and foremost, that's confidence. So as you indicated, this government of national unity, rightly or wrongly so, it's given the market some confidence. And you haven't seen that come through yet in terms of your confidence indicators, because remember, they will lag a little bit. So in the next 2 months or so, 3 months, you're probably going to see an uptick in some of those confidence metrics. But that's not enough, because if I'm confident and I now look at South Africa, I'm going to see, well, there's an energy deficit. So how do we fix that? We open up to international and private capital, even in South Africa. We deregulate industries. We incentivize actual investment from private sector into the stuff that South Africa needs. And what is that? Like I say, I think South Africa has been very successful if you look at renewables. South Africa's invested a lot in renewables, and now it's probably a little less topical because, over the last couple of months, Eskom has miraculously managed to keep the lights on, which is a good thing. But it might also then disincentivize investment in energy mitigation. So just keep an eye out on that. But energy is important. Then over the last year, probably over a year, probably the last 2 years, we've actually had a massive disappointment from infrastructure by way of Transnet, in that we can produce the goods, we can dig it out the ground if that's what we're doing, but then getting that onto the rails and getting that to a port and then exporting that to international markets, that's been breaking down. So investment in transport and logistics infrastructure, not just rail, but we've got to get our ports right. And why is rail so important is for large bulk product, if we're talking resources or if we're talking manufactured goods, it's the cheapest way to move goods to port and get it to export markets. And those are some of the sectors where South Africa has been significantly lagging. I would say infrastructurally, that is what South Africa needs to focus on getting right now, because that starts to turn the corner in terms of getting your goods to market, getting that deficit right. And when you start doing that, the confidence comes through. It's this virtuous cycle. And people start saying, oh, well, maybe the metrics don't look so bad. The deficits aren't so bad. And then we can actually build a little bit more of an investment case around invest in South Africa.
Discussing energy, we're in this sort of era of this energy just transition, where we're trying to, use more renewable energy and get rid of the dirty energy coal, right? But we figured out that that's not really sustainable, right? Regarding advantage, regarding coal and, our mineral resources, right? So how efficient is the energy just transition regarding, our financial markets and the economy in South Africa?
My view on this is going to be multifaceted, right? Because first and foremost, I want to come out and I want to say, yes, I believe climate change is something that is real. It is something that is urgent and needs to be addressed on a global scale. The contention, or the point of contention here, is that developed economies have done a lot of damage to the environment and to the climate. And I would almost argue they've got to do some of the heavy lifting in terms of getting this net zero to work. If we bring that back to South Africa, you're 100% right. South Africa has a very, very large and very low cost coal resource. And so to ask South Africa to just disregard that is, I would argue, not necessarily fair, because I believe coal is probably going to constitute a significant portion of South Africa's baseload electricity generation for quite some time. I mean, we've just invested billions and billions of dollars into the new power stations, and we've got coal, and we're going to dig that coal up and we're going to burn it and we're going to generate electricity. However, to do that in isolation is probably not correct. So this is where the just energy transition comes in, is that South Africa simultaneously, just because there's such a big energy deficit, South African economy has a hard cap on it from an energy restriction. If we just produced a lot more energy, it would provide that breathing room for industry to actually start to grow. Because I've waxed lyrical about how we need to build a manufacturing base. Well, guess what? You can't do that if you don't have energy. So you've got to get the energy right. And so I would say, yes, we're going to have to continue burning the coal. That is a large portion of baseload. But at the same time, we've got to make significant investments into renewable energy. And South Africa, again, it's not just the coal where South Africa is blessed. South Africa is blessed with tremendous sunshine. So solar is actually a reasonable energy source in South Africa. Wind is a little less reliable, but solar is arguably in South Africa, if you map it in terms of just the number of days of sun that you get, solar is a very viable energy source from a renewables perspective. And there the opportunity lies again. And not just, we don't just generate the solar, you've got to store that. And so South Africa should be considering how can we locally produce some of the battery technology and the batteries that will need to go into energy storage from solar. Like I say, multifaceted, we can't ignore the just transition. I think it's important for South Africa to do its bit in the world in terms of some of the newer energy that is putting on stream, but do that alongside our traditional baseload, which still happens to be coal right now. And then last point here, nuclear. And I know this can be very contentious, right? And my view on nuclear has been consistent over the course of my entire career. And again, there are probably some audio clips out there years and years ago where I'd said, I believe nuclear should be part of South Africa's baseload. We've just got Koeberg. And nuclear is clean energy. Yes, it's very expensive, but it is reliable baseload over the long term. And I believe it's something that needs to come back onto the agenda in South Africa. Certainly, there's been a lot more talk about that over the last year. You'll probably see that start to generate a bit more interest, but this hinges on the politics as well, right?
Could you just sum up the key trends and the events in the financial markets, especially now in the second quarter?
I mean, key trends over the last quarter was just a massive outperformance from the US versus everyone else in the world. Emerging markets, however, present a very high potential long-term growth story. And South Africa is an emerging market. We're just doing a lot of stuff wrong that we need to get right. I think we've touched on a lot of those points. You've got to get those foundational building blocks right. And once you do that, South Africa should return back onto the agenda of international investors. South Africa's managed to hold its own in what has been a very tough international market for several emerging market economies there as well. But if we start to do the right things, that can start to filter through to a broader macroeconomic performance, which then has a positive impact on South African society as a whole.
Thank you. Thank you so much. Thavir, do you have any questions?
Yes. Hi. I'm Thavir. I'm a contributor and researcher on Finance Unplugged. I have one more comment to make, just trying to tie through the different conversations we had on energy and on the budget, the trade surplus and deficit. How do you think the closing and ceasing of operations of oil refineries in South Africa? We talked about the secondary sector and not being able to import raw oil and then refining it onshore. Please maybe comment on the effects that's having on our energy security here in South Africa.
So if you look at oil specifically, you've got to break down the value chain. Again, I'm not an engineer. I might be speaking to some engineers on the show, so I'd love to hear your views as well. There's the extraction, crude oil, effectively, and then there's the refining. And
yes,
certainly in terms of when I last looked at this, refining margins were actually really terrible. You know, they weren't great. And so if you've got negative in some aspects, you've got negative refining margins, it doesn't make sense if you don't have the ability to refine a product competitively. And I think that has certainly filtered through in terms of South Africa, is that as a refiner, the sense I got is that we're just not as efficient as getting the product in. So sometimes you're going to have a comparative advantage. Sometimes you're not going to have a comparative advantage. Now, if you have deep pockets, think of what Qatar did, for example, with LNG, liquefied natural gas. They didn't have a competitive advantage for the longest time, but they invested over the long term and they built a competitive advantage. South Africa could probably consider doing that, but the size of that specific natural resource in South Africa is probably not large enough to warrant that level of investment. If you just look north of our borders, though, if you look at Namibia, Namibia has been performing phenomenally well. They've been producing the kinds of returns you want to see out of emerging markets. And a lot of that has been based on, again, primary extraction, mining. There's a lot of energy coming through there as well. So I would argue that we've got to look at where we have a comparative advantage. And if the size of the resource bodies are deep enough to actually warrant a long-term investment to build an entire sub-industry and a beneficiation industry, then go ahead and do that.
So I just have a question on the energy conversation and the idea of secondary production in South Africa, the recent closure of our many refineries. I know we can either import refined crude oil or raw crude oil, and maybe importing raw crude oil and producing it onshore would help us with our budget or our trade deficit rather. What are your thoughts on local refining?
Yeah, Thavir, I mean, that's a great question. And, at the onset, let me say I'm not an engineer. I'm probably speaking to some engineers, as Thabang indicated earlier, probably speaking to some engineers. So I'm keen to hear your thoughts as well. And maybe, again, hit me up on social media at Mohammed Nalla, that's on X. Initially, if you look at, just how our interplay has been from an energy security perspective, South Africa is a net importer of refined product effectively, right? And to your point around the closure of refining capacity, you've got to break that value chain down, because when you're looking at oil, you can break it down into just extraction, that's crude oil, getting that out effectively, and then the refining component. And certainly the last time I had looked at this, refining margins are not particularly competitive. If you're looking at refining the product and you're ending up with negative margins at a refinery level, it means that you're not an efficient refiner of the crude product. And in that instance, we need to think long and hard, because you don't want to be uncompetitive and effectively then introducing a higher cost than you can get if you were actually bringing in refined product. So yes, I take your point. You've got to try and balance out the trade balance side of the equation, but you also have to make sure you can do that in areas where you are competitive. And if we can use a great example, just look north of South Africa's borders. If you have a look at Namibia has been doing fantastically. If you look at their economic performance over the last couple of years, that's been running at 4-5%, some quarters even hotter than that. And a lot of that has been premised on the primary sector of the economy. It's been extraction of resources, mining. There's also been a lot of investment going into energy. So South Africa needs to look at where can South Africa be competitive? Where do we have a comparative advantage? And then look to extract that. And that might be in beneficiating some resources, but it might not be in beneficiating some resources. In some instances, we might just be very efficient at getting stuff out of the ground, but then someone else can refine the product a lot more efficiently than we can. It's a much more detailed discussion that requires a view from experts like engineers to say, these are the resources where we have a comparative advantage that we should look at beneficiating, and on others, that's simply not going to be the story.
Yes. Okay. Then that's maybe a conversation for another day. Do you think the lack of logistics infrastructure, or efficiency rather, and the cost of energy maybe being high, industrial energy supply from Eskom, for example, do you think that's maybe eating into the profit margins of local refining?
It certainly could. I haven't looked at it specifically on the refining side of the equation, but we saw this, right? We saw this, for example, with regards to smelters. We know smelters are very, very energy intensive. And we knew that Eskom, as they ran into the crisis, needed to relook at some of their preferential supply arrangements that they had with some of the smelters. And this ended up costing the smelting capacity at the end of the day. So undoubtedly, you've got to look at what are the various components that are making up the costs. Energy is one of those. What are we doing on labor? Because labor is not just how much you pay your labor. You've got to look at labor productivity as well. What is the output generated for every rand we spend on labor? And we've got to start getting efficiencies out of the value chain there, because there's a component of a return that goes to capital. How efficient are our balance sheets? How efficient is our labor? How efficient are we on energy? So, and then again, and I stress the point, is that you might be super efficient at getting a resource out of the ground, and then it sits there because you're not efficient at moving that through your country to a port and getting that to export markets. So that is the reason why deconstructing the value chain comes with so many technicalities. Yes, they say, what's the best way to eat an elephant? Well, one bite at a time. South Africa has an elephant that it needs to eat, and it's well identified. I'm no genius in kind of diagnosing this. South Africa goes through analysis paralysis. It's been diagnosed in 1 million economic plans. The time now is for actual implementation, because we've gone through a period of degradation of infrastructure. Forget building infrastructure, forget building capacity. We've seen a degradation. So now it's about getting it onto the right footing, and that should give you some flex in terms of just flexing your ability to produce goods, get into international markets. Thereafter, you start looking at the growth component.
Awesome. Thank you so much. Off to you, Thabang.
Okay. Thank you so much, Mohammed. Hopefully we see you on the future episodes to come. Guys, make sure to subscribe. Magic Markets. See you there.